Rose Concepcion here from the Money School. In this episode, we will talk about one of the golden rules of investing, diversification. What does it mean to diversify? Diversification is a strategy for managing risk that involves holding a variety of assets. This strategy can be visualized through the saying, "Don't put all your eggs in one basket." Investing comes with many different risks. Diversification can help protect us against some of these risks by ensuring that our assets are not exposed to the same risks. There are two types of risk. Systematic risk affects the whole market. It is caused by inflation rates, political instability, and interest rates. It is not company or industry specific, and it cannot be reduced through diversification. Systematic risk is a risk that all investors must accept. This is why you cannot completely avoid risk when you invest. Unsystematic risk is specific to a company, industry, or country. Examples are business risk, credit risk, and geographical risk. This kind of risk can be reduced through diversification. We can invest in various assets with the aim of mitigating risk while maximizing return. Does this mean we invest in a bit of every asset? Stocks in various industries and countries? Bonds, both government and corporate? Money markets? Real estate? Art? Commodities? Futures? Derivatives? It's a mouthful, right? But if we were to follow the capital asset pricing model, we should diversify across all these. The capital asset pricing model is a model of the optimal portfolio. It asserts that all investors should diversify. According to the capital asset pricing model, a smart investor will want to invest in all the different assets. An optimal portfolio will hold all the assets because while some assets may have higher predicted return than others, they also have higher risk. The capital asset pricing model presents the ideal world, but we don't live in that world. We are enticed by possibly higher gains, or we have too little capital to diversify optimally. But still, even with emotional and financial hurdles, we can strive to ensure that our portfolio is balanced. We can look at our investments and see to it that our assets are not too skewed toward a certain exposure. For example, stock exposure can be balanced by investing in fixed income assets. To balance exposure to Asian markets, you can invest in US markets. When we choose which assets to invest in, it may be tempting to pick only the assets with historically high return. Why would you want to get assets with predicted lower rate of return? Why not just place it all in high return vehicles? There are two reasons not to do this. First, higher return is associated with higher risk. The more you stand to gain, the more you stand to lose. Second, historical performance does not guarantee future returns. No one can predict the future. For example, an industry that is experiencing fast growth at some point may decline in performance over time. And thus, while historical performance can predict potential future gains, it is not set in stone. Because return is not guaranteed, you need to assess your investments not just in terms of their projected return, but also in terms of their unsystematic risks, each of which need to be tempered with risks that are unrelated or would move in an opposite direction. For example, gold is used as an investment to protect against stock market exposure because gold goes up when the stock market goes down. Think of your lower return assets such as money markets, government bonds, and gold as your insurance on your riskier assets. You need to protect your paper investments the way you protect your house. We pay a bit more for protection. In the case of investing, we stand to gain a bit less. But in the event that one part of our portfolio is badly hit, our risk is mitigated. If you are well diversified, when one part of your portfolio is hit, other assets should stay intact or even increase in value. When we talk about diversification, it's not always about diversifying investments. It would be wise to also diversify income streams. When adding to your sources of income, try to add income from different industries or sectors. One of my titas told me before that it's good to have both fixed and variable sources of income to be better protected, and this advice has served us well. Many people lost jobs during the pandemic. If a lost job were a family's only source of income, this would result in great financial strain. My own family is incurring heavy losses from our business in the food industry, which is among the industries hardest hit by the pandemic. But our diversified income streams are helping us through this crisis. Our fixed income plus income from businesses and other projects ensure that we are not cash strapped. We still have enough money coming in for saving, investing, covering our basic needs, and donating to help our healthcare workers fight the pandemic. On a final note, achieving financial freedom involves taking risks. But if we employ diversification, we can better protect the wealth that we are building. So I hope this video has helped you learn more about diversification. Please like and subscribe to The Money School. Comment below your thoughts or any questions you might have for me. Stay tuned for my next video. Let's learn more about money. Thanks for watching. Bye!